Hello traders, welcome back to the Forex Gig, where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about a stop and reverse strategy, a powerful approach that can transform your trading game. If you have ever been exited in a losing trade only to watch the market immediately reverse in your favor, you will want to pay close attention. This strategy not only helps limit your losses but also allows you to capitalize on market reversals. So by the end of this video, you would understand what the stop and reverse strategy is, how it works, and how to implement this strategy to your trading system. So stay tuned as we explore the game-changing technique that could significantly boost your trading performance. So we start by understanding the concept, and let's dive deep into what the stop and reverse strategy actually is. The stop and reverse strategy is the SAR, a trading strategy that has a powerful approach that goes beyond traditional stop loss method. While a convenient stop loss exit rule exit your position to limit losses, the SAR strategy takes it a step further by simultaneously entering a new position in the opposite direction. This allows you to not only protect your capital but also potential profits from unexpected market reversal. So let's see how we can impute this stop and reverse strategy to our trade. To effectively use this stop and reverse strategy in our trading, you need to follow a structured approach that ensures precision and minimize risks. This strategy revolves about the exiting your current position when the market moves against you and simultaneously entering a new position in the opposite direction. Let's break this down step by step so that you can implement this seamlessly in your trading. The first step is to identify the market trend. You can use the higher time frame to identify the trend of the direction, and as we can see, the market is trending to the downside. In this particular area, we can see the market is trending to the downside, making a series of lower lows and lower highs, lower lows and lower high. So particularly we are in this area in the market where price is touching the trend line, expecting a down move. When we notice where the market is, we can also use the moving average to confirm the trend. For example, if price is above the 50 moving average, you can say that it is in an uptrend. When it's below, you can say it is in a downtrend. The fundamental steps ensures to align your trade with the broader market direction. So if we are to use our moving average, let's assume we add our moving average to this indicator, to this our chart. We set our moving average to at least the 50 moving average to say this is the 50 moving average. This has shown us what we are expecting price to do. If we notice, we can see that price is consistently below the moving average, which signals lower prices or signals that we are in a downtrend. This is what the moving average will help us do. Once you have identified the trend, you would apply your parabolic SAR indicator. This is your parabolic SAR indicator. We will apply this to our chart. Once we have applied our parabolic SAR indicator, this tool is essential for the SAR strategy because it visually signals potential trend reversals. This indicator appears at dots posted either above or plotted over either above or below price bar. When dots switch from below to above, it signals a bearish reversal. When it switches from above to below, it signals a bullish reversal. These dot shifts are your clues to executing your SAR trade. When it switched from below to above, it is signaling a bearish reversal. From bearish to bullish reversal. This is how your parabolic SAR is being traded. After spotting the potential reversal signal with the parabolic SAR, you confirm it using other indicators or price action. Now let's assume that price is switching below from above to below in this area. This signals a buying opportunity. After spotting the potential reversal signal with your parabolic SAR, you have to confirm using additional indicators or price action pattern. And as we can see in this area, price is about to break the structure. It's created a higher low, signifying that price might probably start moving to the upside. You can see this is a higher low. We're expecting price to break this previous area in the market and signal higher prices. So this is basically what we are expecting price to do in the market. So once we have done that, we can use our RSI indicator to further confirm the bearish reversal on our chart, to check if the price is in an oversold region or overbought region. As you can see, it is below the 40. When price is at 40 region, it means that we are in an area that price is getting to its bullish area. We can see price is heading towards the oversold region, signifying that we are looking for higher prices from the RSI indicator. Now comes when we would want to enter our buy signal. For this reversal signal, you enter your trade for a long position. Once we have confirmed from our RSI that we are getting to an overbought region, or we are leaving an oversold region heading towards an overbought region, when the parabolic SAR switch direction from bearish to bullish, we will enter our long position at that area. This is where we would enter our long position. Remember, once we execute, the reversal signal is confirmed. We execute when we enter our trade. We should have entered when the reversal signal was confirmed. This is where we enter our new trade, and it has to be in the opposite direction. I repeat, if you strengthen your case for your buy position, you would want to enter your position. Okay, let's quickly understand it because it might confuse some traders. So if we enter a long position because the parabolic SAR has aligned, it is trading, the dots are below our price, signaling higher prices, and we can notice that from our RSI we are leaving an overbought region. We can enter a buy trade, but the moment we spot our parabolic SAR moving to the downside, you will quickly exit your buy trade and enter a long trade immediately. This is how you trade this strategy. Once you notice the parabolic SAR has changed direction and is trading from above, you will immediately exit your previous position and enter a sell trade in the opposite direction. This is how you capitalize on this strategy. This is, for example, if you are holding a short position and the parabolic SAR is also moving in a bullish reversal signal, you have to exit your short position and enter a long position simultaneously. This is the same thing we talked about here. So if we are trading using this short position and the moment price gets to an area and the parabolic SAR is moving below price, you quickly exit this your position and quickly enter a buy trade in that direction. This is how you capitalize on this stop and reverse strategy. Remember, risk management is crucial in the SAR strategy. You would always have to place your stop loss slightly beyond the most recent parabolic SAR dot or a key support region. So if we enter a trade in this area, we put our stop loss just below the parabolic SAR dot. This is where we put our trading stop loss. If we had taken our sell trade in this area, remember we took a sell trade in this area. When you take a sell trade in this area, we put our stop loss just above the parabolic SAR dot. This is where we put our stop loss, and we ride the trend till when we see a change in the parabolic SAR dot. When it moves above or beyond, this is where we would change and put our stop loss. Your stop loss should always be set in a previous low resistance point or a previous support region, a previous swing high or a previous swing low that aligns with your parabolic dot area. Next is to set your take profit level. You can set your take profit target strategically using previous support and resistance level or benchmarks for taking profit. There are benchmarks for taking profit, so you can use previous resistance level. Remember, this moving average can act as a resistance level. So when price gets to all this resistance level, or you can draw your resistance level on the chart, this is where you would want to exit your trade. Resistance or support level when it gets to a selling opportunity, when price gets to a previous support level, you can decide to exit your trade in that area. These are places you can exit your trade. Another way to exit your existing trade, you can also use a trailing stop loss by adjusting them according to price movement, allowing you to maximize on gain during a strong trend. So when market is moving to your direction, you can always use a trailing stop. While price is moving in your direction, you'll be putting your stop loss above your profit, and you will be gaining using this method. Finally, always manage your position size carefully based on your risk tolerance and your account size. Determine how much capital you are willing to risk per trade and adjust your lot size accordingly. A general rule of thumb is to risk no more than 1 to 2% of your trading capital of your trading account on a single trade. So if you are to risk an amount on your trade, let it not be more than 1 or 2% of your trading capital on a particular trade. By following these steps meticulously, our stop and reverse strategy can help you to stay aligned in the volatile market while continuously maintaining a position to capitalize on price movement in either direction. You have to always practice this technique on a demo account first to refine your skills before applying them in the live market. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, share and subscribe. Turn on your notification bell so that you will never miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.